What's up everybody, Gen X Dividend Investor here. In this video I explain what happens to your stocks and bonds and such if your brokerage firm like Fidelity, Vanguard, Schwab, or whomever goes under. This topic is something that most investors eventually wonder about, especially as their portfolios get larger, so I think you'll hear some valuable information in here. Finally, I'll end things by sharing an interesting TV clip from last week of a well-known dividend investor who sees signs that value stocks are probably about to get some more love soon, so I encourage you to watch this whole video. Now, the idea for doing this came from a subscriber of mine who left a comment on a recent video I did about my $3 million dividend portfolio, where he asked me if I had any thoughts on a huge sell-off happening in SCHD, given that Schwab had another rocky quarter. For reference, SCHD is Schwab's US dividend ETF and is about 7% of my portfolio, so I thought it would be helpful if I explained why I believe that SCHD will be fine, and in fact, more importantly, why I think most portfolios would be fine, even if your brokerage does the unthinkable and goes bankrupt. So to kick this off, take a look at the chart of top brokerage firms in the US. What we see is that Schwab, Vanguard, Fidelity, and JP Morgan are amongst some of the biggest ones out there, all with trillions under management from millions of customers. And here's a chart which ranks some international firms by assets under administration, and we see that Interactive Brokers is on top of this one. Anyway, while it's rare for a firm that provides brokerage services to go bankrupt, it has happened before. Like we saw how Lehman Brothers, which was an investment bank, ended up having the largest bankruptcy in US history and was amongst the most significant events of the 07-08 financial crisis, and it took 14 years for Lehman customers to receive what they were owed. Now, when a brokerage fails, then the Securities Investor Protection Corporation, or SIPC, works to transfer customer accounts and assets to a new company that has brokerage services. You can check if your brokerage firm has SIPC protection by going to SIPC.org and doing a search, though realize that some brokerages might be under another name, like E-Trade was bought by Morgan Stanley, so you'd need to search for that, or Schwab is listed under Charles Schwab, etc. I use Fidelity for my portfolios, and I see that Fidelity Brokerage Services has SIPC coverage. The SIPC site also has a section showing open cases they're dealing with, and this shows that some of Bernie Madoff's customers are still dealing with the fallout of his actions. Remember, that ended up being the largest Ponzi scheme in history, defrauding thousands of investors out of an estimated $65 billion over the course of over 15 years. Bernie apparently promised people high returns in exchange for their investments, but their money was never actually invested. Yikes. Now, if your brokerage firm goes bankrupt, but is covered by SIPC Insurance, as most brokerages in the US are covered, then you'd need to file a claim on SIPC.org for your stocks. SIPC protection is limited to $500,000 for securities, of which no more than $250,000 may be for cash, and it doesn't cover some losses such as market losses or investments in unregistered securities. However, it looks like your main brokerage account can be covered up to $500K of securities, and if you had an IRA, it could also be covered for another $500K. You can check out the SIPC fact for more details about your particular realities, as there are a lot of nuances depending on various people's situations and the assets they own in their accounts. And remember, I'm not a financial professional, I'm just someone who likes stocks and appreciates being able to share my perspective on things. When my accounts went over the $500K mark, I called up my brokerage firm to ask them if investors tend to split their accounts across multiple firms in order to get around the SIPC limit, and they said that some do, but most don't, because big brokerages like them actually get extra portfolio insurance through Lloyd's of London. And hang with me for a sec, because this next part I'm going to share is important to understand. On Fidelity's page, I found this section that says, in addition to SIPC protection, Fidelity provides its brokerage customers with additional excess of SIPC coverage. The excess coverage would only be used when SIPC coverage is exhausted. Like SIPC, excess protection does not cover investment losses in customer accounts, including losses due to market fluctuation. For example, fraud claims would not be covered if the brokerage firm was still in operation. Total aggregate excess of SIPC coverage available through Fidelity's excess of SIPC policy is $1 billion. Within Fidelity's excess of SIPC coverage, there is no per customer dollar limit on coverage of securities, but there is a per customer limit of $1.9 million on coverage of cash awaiting investment. Now, my first thought was, wait a minute, Fidelity has trillions it deals with, and that blurb seems to imply a limit of $1 billion extra. But one thing you got to realize is that the vast majority of Fidelity clients are under the $500K SIPC limit for their accounts, so they would be protected, in theory, by SIPC, and thus they wouldn't tap any part of that billion extra. But the bigger accounts, like the 7-figure or way larger ones, would in theory all vie for that billion excess insurance coverage, which means they might get impacted. I've personally decided not to split my portfolio up across multiple brokerage firms, though I do know some people choose to do that. For me, it feels like too much of a pain doing that, and I'm guessing that the likelihood of Fidelity going under and me being materially impacted seems too low to do it. I think if my portfolio got to the 8-figure mark, then I'd probably split it into 2 brokerage firms. That all being said, there is another layer of protection out there, and that's the usage of custodians that brokerage firms use. You see, some additional safety you get is that when you buy stocks at a brokerage, those stocks' assets are yours, not theirs, and my understanding is that brokerage firms are required by law to keep those assets out of their control, at least to some degree. And specifically, your securities are actually held separately by a custodian company, which is another layer of safety even if your brokerage goes under. So custodians are basically third-party record keepers that help keep your securities segregated from the brokerage firm. Take a look at Schwab's site to see what I mean. Here it says, the first thing to remember is your securities, like stocks, bonds, mutual funds, exchange-traded funds, or money market funds, held at Schwab are yours. The SEC's Consumer Protection Rule safeguards customer assets at brokerage firms by preventing firms from using customer assets to finance their own proprietary businesses. At Schwab, clients' fully paid securities are segregated from other firm assets and held at third-party depository institutions and custodians such as Depository Trust Company and Bank of New York. There are reporting and auditing requirements in place by government regulators to help ensure all broker-dealers comply with this rule. In the very unlikely event that Schwab should become insolvent, these segregated securities are not available to general creditors and are protected against creditors' claims. Or to say that differently, your brokerage firm should use third-party firms to better safeguard your assets, and that's true whether you were talking about Vanguard ETFs or your Schwab ETFs or whatever. And note, Bernie Madoff was actually someone who didn't use a custodian and thus broke further laws which ended up screwing people. To find out what third-party custodian Schwab uses for SCHD, you can dig into their documents on their site and you'll find out that they use a company called State Street. So if Schwab goes bankrupt, then in theory your SCHD holdings should still be safe and secure due to the other layer of protection in the custodian company. Of course, I'd bet that if Schwab went bankrupt, then its personal tickers, like SCHD, would probably have a lot of downward pressure due to people being freaked out, but market volatility is something you gotta deal with. The reality is nothing is guaranteed, but one of the riskiest things to do, at least in my opinion, is to not invest because you feel doing so is too risky. Plus, if I think about it, custodians themselves tend to be large financial institutions that I bet the government would say that they're too important to fail. And if a custodian bank becomes insolvent, regulators typically respond by arranging a merger or taking possession of the bank. The bank is then closed and its assets are sold to a third party. Custodied securities are usually returned to each investor since they're kept off the balance sheet and generally should be protected from creditors. And in some cases, securities may be transferred to another account at a different custodian. That being said, we know that big financial companies like Bear Stearns and Lehman Brothers became insolvent in 2008, but apparently no brokerage clients lost any shares of their stocks, bonds, or mutual funds. So are your ETFs safe? I'm guessing probably so. Let's take a look at VTI and VU, two very popular ETFs that a lot of folks have. This document says that Vanguard uses multiple custodians, including JP Morgan Chase, State Street, and Bank of New York Mellon. So they all seem pretty rock solid, and unless the entire financial system was melting down, I'd envision that you'd probably end up being okay. Another benefit of having a separation between a custodian and the brokerage firm is that it reduces the likelihood of fraud, though it doesn't mean nasty people won't figure out a way to do sneaky things that could still negatively impact you. I mean, in 2011, there was a huge financial firm called MF Global that collapsed and was the 8th largest bankruptcy in history at the time. Its CEO was a former governor and senator, and it was especially controversial because customer funds disappeared in the final days of MF Global's existence. They were a commodity futures broker, and there were a variety of things that contributed to it going under. One was from mismanagement, as their CEO also served as their head trader, which can lead to obvious new risk scenarios. Allegedly, they used customer funds to cover their own trading losses, which resulted in $1 billion in customer accounts being impacted. But a couple of years later, a settlement was reached to return 93% of customer investments, with the possibility of additional payouts later. So again, nothing is guaranteed to be safe, but regulations and laws and such are often put in place in an attempt to make the financial system work. If you're a serious investor, then I'd recommend sticking with big boy names like Vanguard, Schwab, Fidelity, JP Morgan Chase, etc. So bottom line, my understanding is that neither brokerage firms nor custodians should have any legal claims to your assets either before or after bankruptcy, and that the creditors of bankrupt firms have no right to claim your assets either. And as an example, in the unlikely case that Vanguard went under and your assets got moved, let's say to Fidelity, then I wonder if VU would be renamed FU. I can tell you that I'm not losing any sleep at night, worrying that these crazy edge cases could realistically happen, even though I have the far majority of my net worth in the stock market. But that's just me, you should do what makes sense to you. And to answer my subscriber, I think Schwab will continue on even if they had a rocky quarter, and I'd actually be happy if there was a sell-off in SCHD, as it would let me continue to accrue more shares at cheaper prices, because I'm betting that SCHD will be around at least as long as I'm alive, if not longer. I like my dividend tickers I own like SCHD, and even with the various risks out there, I still feel that equities are the best way to create long-term wealth. which is why my YouTube channel and my portfolio are both focused on dividend stocks. What's cool about quality dividend stocks is that as the market goes up, your portfolio also tends to go up. And now listen to this 60-second clip of Jeremy Siegel, a retired business school professor who's known for liking dividend stocks.
Basically, it's forward inflation, and that looks very, very good to me coming from the data that I research.
Let's take a look at what we've seen in the markets. There have been some big rotations over the last several weeks and even last several months. One of them is this move towards small caps away from the big caps. The other is this move towards value over growth.
Yeah, and actually, both of them are tied together quite strongly. I mean, we had up until about 2.5 weeks ago, we had a month period of one of the strongest growth pushes relative to value that I've ever seen, and then in just 2 weeks, pop, it's gone. It's sort of easy come, easy go. But if you take a look at the long-term trends, actually, growth versus value is back to that trend before we had that pop bubble. But you know, as I said many weeks ago, you're not going to get value moving until the Fed drops rates. And more when you see that, you know, rate drops are in the cards for the Fed, I think that narrative could very well continue.
Nice. Siegel is an advisor to Wisdom Tree Investments, the folks who have various ETFs you might recognize like DGRW, the U.S. Quality Dividend Growth Fund, a 5-star rated ETF per Morningstar. My point in sharing that clip is to highlight that more and more folks are thinking interest rate cuts are coming soon, potentially starting in September, and if that happens, then dividend stocks will probably help drive portfolios up. Of course, no one can always predict the future, but I have noticed more people are saying that interest rate cuts are coming very soon. Like as I was working on this section of the video, I saw an article come across my news feed which said that regional banks are preparing for interest rate cuts from the Federal Reserve. Regardless of what happens, us blue-chip dividend investors often do nicely when markets are going up, and we do fine when they're going sideways, and we tend to lose less when the markets dip, and regardless of all that, our income tends to keep trending up. I found it to be the truly least stressful and most rewarding way to invest I've ever come across. One thing that did happen to me as I was researching this video is that it dawned on me that I should probably be holding a bit more cash, because if some crazy edge case happened, then I need to make sure that I have enough liquid money on hand for at least a year of expenses, and right now I'm holding less than that. I tend to be someone who gets their money into the market as soon as I have it, and I keep my emergency fund rather small, as I figure I could worst case liquidate stocks if I indeed needed more emergency funding. But what would I do if I couldn't access my stocks for a period of time if something went under? Something I'll have to noodle over. And with that, I'd like to close things off and recommend that everyone consider using my FastGraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. I'll also recommend checking out my Seeking Alpha affiliate link, as new users can often get good discounts for signing up. Plus, take a look at my Patreon seats to see if there are any you want to sign up for, but since my Patreon Aristocrat and King seats are usually sold out, I'll also recommend that you join my channel membership, which gives you a variety of perks you can check out. But whatever you do, please hit that thumbs up button, subscribe if you haven't yet, and click the bell notification. And don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 81 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.